Hello and welcome to this month's Financial Markets Update. Well, January kicked off the calendar year in really solid fashion. We saw some strong investment performance in equity markets, both domestic and global, over the course of the month, as well as bond markets, with yields declining right across the curve over the course of January. When we think about what precipitated the rally in January, particularly after what was a very difficult month in December, from our point of view, there was probably two key elements that drove markets higher over the course of the month. The first of those related to the continuing moderation in inflationary expectations by investors. And, we've seen that in the context of inflation prints, particularly out of the US, throughout the course of 2022, continue to moderate through the back end of 2022. So the expectations that central banks wouldn't need to be as aggressive throughout the first part of 2023, we think obviously fed into investor expectations, as I said, helped the rally throughout January. The second of those was the pivot by the Chinese government away from COVID zero, COVID lockdowns, to really just reopening the Chinese economy and a focus back on growth. And, the uptick in economic activity that's expected throughout the course of 2023, we believe to be positive, not only for Chinese as well as other emerging market equities, but will obviously be beneficial to overall global activity and certainly alleviate some of those supply chain pressures that we continue to see in parts of the global markets. So from that perspective, we think that that was positive, and we continue to see that play out. However, when we think about sort of the outlook for 2023, and certainly in the early part of February, some of those aspects have been hit on the head, so to speak, and certainly domestically, when we think about inflationary expectations, the December quarter was one of the highest rises in inflation over the quarter, 1.9%. So we haven't seen that over a quarter since the early part of 2022. And inflation still remains at a level well north of the RBA's 2 to 3% target band. In fact, it's close to over 7.5% here domestically. So we have seen cash rate rises here in Australia throughout the early part of February, as well as obviously in other global jurisdictions. And certainly the mantra coming out of central banks more recently has been that cash rates are going to need to go higher throughout the course of 2023 in order to further curtail inflationary expectations and really dampen economic demand in order for those inflationary pressures to moderate. We think that's a twofold aspect. As I said, if we see greater economic productivity, certainly, as I said, to alleviate some of those supply chain issues. The challenges that we're seeing in Ukraine aren't going away anytime soon, so certainly some ongoing pressures there, particularly around some of the commodity markets and the like. But consumer demand is starting to moderate, and even though we are expecting that central banks around the world are likely to increase cash rates further, and certainly the peak rate for cash rates is likely to be higher than what was anticipated 3 to 6 months ago, we do believe that rate rises in 2023 are going to be far less frequent and not as aggressive or significant in terms of their absolute moves to what we saw in 2022. So the challenge for investors, in our view, is really going to be in the first part of this year, because as inflation does start to moderate, we believe central banks aren't going to be as aggressive in cutting rates, and therefore the impact on the economic cycle and economic activity, both domestic and global, is likely to be a little more pronounced. And in the context of major developed markets, it's certainly our core view that we are likely to see a further contraction in economic activities, certainly through the first half of 2023. So from an investor's point of view, even though we saw a really solid month of January, we wouldn't take that as a precursor for most months throughout the course of this year. We think that volatility on a month-to-month basis is going to remain elevated, but we certainly are of the view that once we start to see peak cycle rates come through, once we start to see further evidence that inflationary pressures are going to moderate, we think that that is going to continue to drive an upward trajectory in both equity and bond markets. Cash rates, as we've said, are expected to move higher. That's flowed back into bond markets, and we do think there are some attractive opportunities on that front, as well as obviously a rebound in the growth outlook through the second half of this year, we believe will also be beneficial for equity markets and corporate earnings more generally. But overall, it was a pleasing start to the year. As I said, there's a lot more in terms of challenges ahead for investors, but as I said, are nice to have after what was a very difficult into 2022. As always, if you have any queries about your investments, please feel free to reach out to anyone in the team, and we'll catch up again next month. Thanks and bye for now.